Okay, so this is a review of the case, the Parts Emporium case, on inventory management. Chapter 9, it's on page 357. Just got a couple things I want to mention about inventory management. It's very important, particularly in manufacturing, as you might imagine, but it's also important in service. A couple of distinctions to make. Inventory is defined based on the perspective that you look at it from. So a company accountant or finance guy, the people that always take care of the money, they really define inventory only in three forms. It's the raw materials. So if you're a manufacturer, this material comes in and gets stored. It's generally considered to be as good as cash in the sense that it can be liquidated, usually pretty easy. And then we have work in progress. So this is when you take raw material or sub-assembly that you've purchased and you begin the manufacturing process with it to make something. Work in progress is considered to be kind of an asset from a finance perspective, but not something that's easy to liquidate. Not as good of a stable item for cash flow, so on and so forth, if that was needed. And lastly is the finished goods, and this is when your manufacturing process is all done and you now have something that again is generally considered to be liquidatable fairly easily. Now for us, we're going to be talking about operation. We don't use the same distinctions. They're important to know, but we're going to talk about some other things. First thing we're going to do is talk about cycle inventory. And the cycle inventory is basically the fluctuation in inventory from a maximal value. So this is you have all the inventory you need to meet the current demand coming, and you have it in your possession. It can be in a warehouse, it can be on a loading dock, but it is yours. You own it. Or we own it. And the cycle inventory is going to vary between the maximal, so that's when an order comes in, usually you're at your maximal inventory. So you've ordered something in and you have the maximum you can have, and zero, which means you have none. But, there's always a but, that doesn't take into consideration safety stock. So you don't ever want to run out of something. And there's a whole lot of things I could talk about on safety stock, but needless to say, safety stock is nothing is ever certain in the world, so demand is not certain. So sometimes you're going to need to keep a little more stock on hand, and that's your safety stock to make sure you don't run out of stock and send your customers or consumers somewhere else. And anticipatory stock, and that's the stock usually that you would do to deal with seasonal fluctuations or cyclic fluctuations. It's not always seasonal. It's anticipatory inventory. You're anticipating the demand. And lastly, we have pipelined inventory. So I mentioned earlier about having something in your possession, like it might be on a loading dock. Things that are ordered and they're either being manufactured for you by somebody else or they have been shipped by somebody else. Those are pipeline inventory. So you've ordered it, you've made the contract to pay for it, but it hasn't been delivered to you yet. It's in the pipeline. So I think that's the only things I wanted to talk about before really getting heavily into the case content and working some of these things out. Okay, so the case has a lot of data and it has a couple of questions. So the two questions it asks are basically a proper inventory management system given a bunch of data that's been provided to you by some subordinate and as an operations manager, and what do your recommendations do to a few figures, the cycle inventory, stock out, and ordering costs. The first thing I usually do when I get a lot of data like that is start plugging some data into something, and in this case we're given enough data that I just started plugging it into Excel. So this is the table that I came up with, and I just want to bring some things to your attention. First thing is the mean weekly demand. I mean, these two things here are just the averages. So you just use Excel and you use the average formula and it comes out. If you have a scientific calculator or a financial calculator that does statistics, you can key all the numbers into that and you'll get the same answers. Once you do that, you can get the standard deviation of it. So you just say, give me the standard sample deviation for those two things. So we get the drive belts and the gaskets. And again, this is just some statistical calculations. Use Excel. And now these two red numbers here, or with red background, for standard deviation, they're a little bit different than above. And what these were, I just wanted to give you an example, is this is the difference in the population standard deviation versus the sample size. So the idea in an ongoing concern is that you can never really have all of the data. You don't know data prior to the year, and you don't know what it's going to be in the future, but the population will be different and change. And because of that, you have to use the sample deviation when you're using Excel. So these two numbers with the red backgrounds are wrong. These are not what you should be using. So keep that in mind. If you were using some population formulas, you really need to be using the sample deviation formulas. So now on to some of the better stuff. Then we have our annual demand. So the annual demand is mean weekly demand times the full year, which is 52 weeks. So just multiply it out. So for this one over here, it's just 102 times 52. And for this one here, it's 52.11 times 52. So again, just a little calculator math. Now the yellow stuff. There's a solution key going around, and the solution key tells you to drop the first 2 weeks for demand. And the reason for that is that it's a new product ramping up, and it's not indicative of what the actual demand is. It's common in statistics sometimes. You'll see people, they'll drop the high and low values and lots of other fancy things. If you did do it, these were the values that you would get, and I would mark them as correct because if you don't state that you're dropping these two, but yet you might have, say, for the drive belts, you had a standard deviation of 1.76, then if you had forgotten to state that you were dropping those two, that's an assumption, so I have to mark you wrong because I would have really expected a different deviation. Okay, so moving right along, take these values, I've just taken them and moved them around a little bit, and this stuff here is information that we're given in the book: the inventory on hand, the lot size, the lead time, how many are back ordered at the current time, how many are on order, and the selling price. We are also given the gross margin, the lot order cost. So this top part up here is all information that I just copied out of the case. No calculations needed. I forgot this one. Inventory holding cost is also in the case. And our cycle service goal. So I might as well talk about that here now. So we're told the cycle service goal is 95%. If you look at the back of the textbook, page 599, so you use that reference and you're going to look for 0.9500. What I did to get this 1.64 is there's a function in most things where you can get the inverse. So it's a statistical inversion. So you key in 95% and you'll get this out. Again, the answer key uses 1.65, which is okay. There's other formulas and other books and other ways to get it out. So whatever you came out with, I checked all the math on everybody's that was different and just saw where the math went wrong, and hopefully you should have feedback to that effect. So one other thing now that we're getting into is the cost of goods sold here, which is this COGS value. And we need that to calculate our holding cost. And I guess it was a little, in my mind, a little bit of a trick in the case that they couldn't just kind of tell you the cost of goods sold because it's about inventory. For the gaskets, we're told that our margin is 32%. In order to figure out our cost of goods sold, essentially what we're going to do is take our selling price, which is $12.99. What we're going to have to do is we're going to have to multiply that by 1 minus our 0.32, which is our 32%. So essentially it's $12.99 times 0.68, and that will give you $8.83. You need that to figure out the holding costs per part per year. Okay, so our holding cost is going to be equal to our 21% times our cost of goods sold, which is $8.83. And that comes out to $1.85. For the other one, it's the same calculation. It's 48% of $8.89. So our cost of goods sold for the drive belt is going to be $8.89 times 1 minus 0.48, 48%. And that's going to give us $4.62. And then our holding cost for the drive belt is going to be 21% of $4.62, which is equal to 97 cents. So again, I'm just going to bring your attention to the stuff in red. If you ignored the gross margin and simply took 21% of our $12.99, you would get a $2.73. If that was you, and I believe there was a couple, then don't worry about it. You didn't get docked too much for that. Again, I didn't feel the gross margin being in there on this kind of a question was super fair. It can get compounded because as we come in now to the economic order quantity. Okay, so now let's talk about our economic order quantity. Yeah, so the equation now for the economic order quantity you can find on page 343. So the economic order quantity is the square root 2 times the annual demand times the setup cost, which is the order cost, over the holding cost. It's the square root of 2 times 5,304 times $20 divided by $1.85. So I'll plug that into the calculator and make sure I got all these numbers done right. So how I do that on a calculator is I do the multiplication first. I go 2 times 5,304 times 20, and that's some giant number. Then I divide that by $1.85, and then I take the square root of it, and then that's equal to, of course, 338.65. Do the same thing, and you get the value 236 for the drive belts. Okay, cruising right along here. We've got our economic order quantity worked out here now, so we're going to work out a few of these other numbers. In order to do our costs and a whole lot of other things, we need to know some extra information. And really, kind of the goal here is to figure out the reorder point. This is for a queue system. So a queue system is the optimal system to use for this, where everything is pretty constant. You could have done the periodic system, which is the P system, but the reorder point or the Q system comes out to be cheaper. I'm just going to work through this one because it is more common these days in many industries because of computerized inventory management and the whole concept of continual inventory management, where a item sold is immediately taken out of inventory. So gone are the days when a cashier would just key in, 99 cents for an item and you didn't know if it was a roll of tape or a container of glue, or some bows for gift wrapping. Those days are long gone, and everything now uses UPC or barcodes, and so the inventory is constantly kept. So reordering is virtually automatic. People don't go and take an inventory and then decide how much to order and then do that once every 2 weeks or once a month or once a year. It's sort of automated, so the continuous review system or the reorder point system is generally more common today. Back to this. So average lead demand. It's the lead time times the mean weekly demand. So one is 2 weeks, one is 3 weeks. So now let's work out the standard deviation during lead time. Standard deviation during lead time is nothing more than the standard deviation multiplied by the square root of the lead time. That time can be in weeks, it can be days, it doesn't really matter what it's in because you're going to get a standard deviation. In our case for the gaskets, it's 2.86 times the square root of 2 weeks. So this is gaskets. And the standard deviation lead time for the drive belts is going to be equal to 1.76 times the square root of 3. And I will work those out very quickly, as much quickly as I can. So it's 2.86 times the square root of 2, and that's 4.04, and we get 305. So again, these numbers over in the table here, these just came from Excel formulas, and all I did is essentially just keyed it in and clicked on the cells. If anybody wants to know how to do that, send me a note and I will do something up for you once the term ends. Okay, now that we've worked out our standard deviation during lead time, we can work on our safety stock numbers. The safety stock number, now we're going to need our service goal. So this is our 1.64, 1.65 number. So all we're going to do is take our standard deviation during the lead time, and we're going to multiply it by our service level, which is our normalized distribution, which is 1.64. And that, I'm going to say, is going to give us our 6.66, which is going to round up to 7. For the other one, same calculation. You're just going to take 3.06 times 1.64, and you're going to get 5.03. So now we've got the safety stock. We know how many we need to keep in stock. That's our low level. So when our cycle inventory essentially is at 0, we're still going to have 7 gaskets in stock and probably just 5 drive belts in stock. So now I'm not going to plug this one in. The simple calculation here is to take the average lead demand, add the safety stock, and we have a reorder point. So when our inventory of gaskets gets to 210 or 211, we are going to order our economic order quantity of 338 from our supplier. Okay, so now that we've calculated all of this stuff up in this upper one, we've got our annual demand, our holding costs, our lot order costs, the current lot size, and the economic order quantity. So the existing order cost is going to be the number of orders per year, which is our yearly demand divided by the lot size, times our order cost, which is 20. So that is going to give us $707. Same thing over here. Okay, so the holding cost right here is then going to be our average cycle inventory, which is our 150 order size, divided by 2 times our $1.85. So 75 times $1.85, we get 138.75. So this is just Excel doing some great rounding. Same thing for the drive belts. Now we calculate our proposed costs, and we're going to have 5304. So again, this is our order cost over our new lot size, which is 338, and times again the holding cost didn't change, $1.85, so 314. Our holding cost is going to be our 338 over 2 times $1.85. Of course, this up here is supposed to be $20. I bet if there was a class, someone would have picked that up. For the holding cost for the drive belts, it's simply going to be 1,000 over 2 times our holding cost, which is 0.97. So it's 500 times 97, which is 485.39, which is right here. Same thing then on our proposed one. We can see here that this one is going to change dramatically. Our proposed order size is 236 over 2 times our 97 cents, or $115. So when we take these numbers and plug them in, we can see that there's a savings of $218, $219 almost. So on the gaskets, we're saving 25%. The real cost savings comes in on the drive belts, where we're saving 55%. So a couple things to point out here is that while on the gaskets the holding cost jumps dramatically from $139 to $314, that is offset by the reduced number of orders and thus the reduced order cost. The same thing can be said as we reduce the lot size for the drive belts, the order cost goes up, but because we don't have so many, the holding cost goes down. Okay, so I just want to go into a few things, a few details about this, kind of a little segue before I just clue up the case. This is the graph here where the holding cost is a constant as your lot size goes up. This is for a product where you get no quantity discounts. The cost is the same every single time, so the holding cost doesn't change as the lot size goes up. The ordering cost, of course, as your lot size goes up, the ordering cost decreases. The economic order is right here. This is your EOQ, and this economic order quantity corresponds to the lowest point in the graph, which is the lowest total cost.